On July 7th, U.S. 10-year Treasury yields traded at an 8-month high of 4.08%. Now, since that time, there have been some significant changes in the tone of the data and its implications for future rate policy that have pushed yields down to their current level of 3.77%. Now, the first shoe to drop was the weaker than expected employment data on July 7th. The labor market had been viewed as one of the strongest parts of the economy and was credited as the most important element in avoiding a recession. Now, in the following days, we saw lower than expected CPI and PPI on July 12th and 13th. The combination of these numbers seemed to convince the market that the Fed was on the cusp of ending its tightening cycle just after the July 26th meeting. The futures market currently has a 97% probability of a 25 basis point rate hike at the meeting, but then rate eases beginning in March, totaling 125 basis points of easing by the end of 2024. This according to the CME FedWatch tool. Now, some traders believe that the deteriorating quality of data should push rates lower throughout the yield curve, but others see it differently. Perhaps a move toward rate eases on the short end could cause rates to go higher on the long end by pushing the liquidation of trades that are long 2-year yields and short 10-year yields. Now, if a trader believes that 10-year yields could continue lower from here, they could express that by selling the July micro 10-year Treasury yield futures contract at 3.77 and target a move to the mid-May low of 3.35. A stop for this trade can be placed above at 4.05. Now, this trade can make $420 if the target is reached and risks $280 if you're stopped at your level. If a trader believes that 10-year yields could return higher, they could buy that July micro 10-year Treasury yield futures contract at 3.77 and target a move to the October highs of 4.25. A stop for this trade can be placed below at 3.40. Now, this trade could make $480 if the target is reached and risks $370 if you're stopped out at your level.